YouTube, what's good with y'all boys? I'm back again with another video, and in this one we'll be going over when to not trade. So this will be a very important video for you guys because a lot of you guys already know when to trade, but knowing when to not trade will help you succeed a lot as a trader. As always, before I get into the video, if you want to become profitable and you can't sit through watching the entire of this video, taking notes and applying it, go ahead and just click the off the video because you're not going to become profitable. The issue you have right now as a trader is that you know when to take trades, you know when to take A+ setups, you know the times to trade, you know your psychology around trading, and you typically have a system, whether it be pre-market or post-market, within trading. So a lot of you guys already kind of know when to take your trades, you know your system, you know when to be executing on a day-to-day basis. However, with that being said, the biggest mechanical issue most of you traders will have, and including me as well, is knowing when to actually not trade. Right now, you typically treat every single setup the same, you treat every day the same, and you treat every session the exact same. So obviously, because of those inputs, there is an equal and opposite output, and that gives us a result of those things. And so what then is the result of those inputs? Well, as you're probably struggling with right now, number one, the main thing will be questioning if your strategy even works. And this was something that I struggled with for so long because I knew the way my strategy worked. I knew when I should be taking trades. I knew what setups I should be taking, but I didn't understand when I should actually not be taking trades. And because of those losses, it would actually make me question my psychology, question my belief, and question if I was even a good trader in the first place. Number two is that it will lower your win rate. A lot of you guys will have an 80% win rate on higher probability days, but the lower probability days you'll have a 40% win rate, and in return it'll knock you down to a 60% overall win rate, when in return you could just completely fade those low probability days and have a higher chance of succeeding as a trader by avoiding those bad setups. And that is what this video is for. Number three, which is the worst one, is you're gonna have a higher chance of blowing accounts, going on tilt, and inevitably quitting trading if you continue this repeated loop. A lot of the times you guys will be in a phase like this, maybe your win rate isn't that low, but literally I've had a student with a win rate being this low, and I've took them to having a 70% win rate by applying the things that I have in this video, as well as you can see, the closed accounts down here that continuously spiral over and over and over again, not because they didn't know the setup, the system, the processes. It's because they couldn't stop trading on the days that we were not supposed to be taking trades on. And inevitably, that is what fries a lot of you guys, because imagine this, right? Let's say Monday comes around, right? Let's say Monday comes around, it's a lower probability day, and you take a trade and it's a bad setup. There's no really good price action, there's no volume, there's no displacement, and you get cooked, you lose $1,000, right? You're more likely to go and blow your account on that Monday because you got that $1,000 loss trying to make it back on a bad probability day than you are to just wait for the next day, which would be Tuesday, which if you blew that account on Monday and you got a new one on Tuesday, you'll notice that Tuesday has a lot better PA and you smack your trade. So that is a problem that I honestly struggled with for so long, and that's inevitably why I'm making this video, is because I would take trades on days and times I knew I shouldn't be trading, and it would cause me to crash out and burn out and blow my accounts, literally doing what I'm saying right here. And then Tuesday, the days that actually had good price action, good volume, good displacement, I would execute and I would win. So I didn't understand for so long. I couldn't understand why this was, and so that is why I'm making this video, because once I became self-aware of these mistakes, that is when I developed as a trader and started becoming consistently profitable over a given amount of time. So now then, once you understand that, the question then becomes, why are we programmed to actually do this? And the number one reason we're programmed to act the way that we do, to act the way that we have, and to continue making the same mistakes that we continue making, is because traders feel like more trades equals more inputs. And you guys have heard this time and time again, but more trades does not equal more input in trading. Everything else behind your trading is the more inputs within your trading. You showing up and taking your one trade per day, executing on your system regardless of the outcome and getting off the charts, that is your input. That is your input on a day-to-day basis. Your input isn't taking more trades. It's not forcing setups when they're not there. Your input to trading is actually waiting until your setup is there, because inevitably that means that you're waiting and preserving capital. That way you can put that capital into a winning setup. That is more inputs in trading. And so when you continuously go down this rabbit hole, you will see yourself spiraling in the same spot for months, if not years on end. And that's why it takes traders so long to become profitable. A lot of the times, once you master your psychology, it really comes down to just not taking trades when they're not presenting. And so inevitably, why our brains are even wired like this in the first place is because in every other aspect of life, more inputs equals more outputs. If you want to get bigger in the gym, you have to lift more. If you want to gain more weight, you have to eat more. If you want to be a better student and get better grades, you have to study more. So more is always forced upon us, and that is why it's programmed in our mind. And that's why trading is so fucking hard, because there's 1% of people that make it. 99% of people don't. Why is that? Because 99% of people are programmed that the more trades they're taking, the more they're applying themselves. In that essence, that the more output they're going to get. In all reality, that's not the truth. Somebody that takes 2 trades a month can make a lot more money than somebody that's taking 200 trades a month. There's no input correlation on the amount of trades that you're taking. It's the quality of setups that you're taking that add to that output correlation. And that is what we want to focus on. So now I know you guys are asking, Dylan, what the fuck is the solution? And that is what I'm going to give you right here. So number 1 will be understanding price action. What patterns do we avoid on a day-to-day basis? What price action do we avoid? And number 2, if you trade IFVGs or the model that I trade, what are good IFVGs and what are bad IFVGs? And so both of those things I want to kind of go into detail on. Number 1 is what patterns. And so with patterns, you can kind of get an idea on a day-to-day basis through discretion and continuously applying yourself as to what patterns are more probable over other ones. And so days where the model or any model that you may trade is more profitable and more probable, more higher probability conditions, is expansion days. Days like this right here, where you can see we're opening, we're obviously expanding, we're taking on draws on liquidity, we're targeting different draws, we're moving with volume and good displacement. These are the days that we want to be targeting. These are the patterns in price action that we want to be targeting and putting money into. Also, you know, an example on a day like this where we have good volume and good displacement as well, you can see that the market is obviously trending. We're not just kind of stagnant in the same direction. We're obviously trending, taking out draws on liquidity and moving with good volume and displacement. Now, bad days that you want to avoid that would be less probable is number 1, which is a very slept on one, is days where there's no retrace. Some days where we come out there and we just dump 400 points off of open or rip 400 points off of open. A lot of the times you want to avoid those days because there is quite literally not a singular setup in these trades. If you look at this down movement right here, at least for my setup, you cannot tell me anywhere there's a winning setup right here. Anywhere, because there's no retrace. There's no better entry in this point. And so a lot of the times you never know, number 1, when the dump or the pump is going to stop. And a lot of the times after we make that move, that's typically the move for New York and will typically accumulate for a good amount of time until maybe like New York PM session. Second one, obviously the most convenient one and the most obvious one, is choppy days. And I cannot reiterate how many times I've seen my students, people on my Discord, even myself get cooked trying to trade these shitty ass price market conditions. These market conditions is literally the reason why a lot of traders fail, because they think that they have to execute every single day. And then when a day like this pops up, you get completely fried in the markets. And that is the worst thing you want to have happen to you as a day trader. And so the best example of a specific day not to trade is literally conditions like this, because you could literally just look at this in hindsight. The beginning of this box is the New York Open. So New York Open's about right here at 9:30 a.m. And you can see how we're just kind of just chopping, not really taking out any displacement, no volume for 20 minutes. And then we go and take out a draw on liquidity of the unfilled hourly before dropping. Ideally, I mean, there might have been a setup to the downside, but you can see the remainder of this session just kind of chops around. So yes, you could still catch wins in these sessions. You could catch a win any day in these sessions, but at the end of the day, you want to fade and be a little bit more risk off on days where you see us open like this, because a lot of the times we will not make a move and we kind of just chop around before we make the move in the PM session, which then ends up being the main driver in the market. So a pro tip for you guys is that if New York AM opens at 9:30 a.m. and we kind of just chop around and there's no setup, kind of like how you see here, the best thing you guys can do is actually just get back on the market in the PM session. And typically PM session is when you'll see us make the move, which is exactly what we did. We made the move to the upside, displays lower, and then we actually had pretty decent price action going forward in the remainder of the session. Now, an example of good price action would be how Friday was, which I have marked out right here. As you can see, Friday, now we immediately open, we ripped to the upside 133 points, ripped back down to the downside 231 points, taking out draws and liquidity in both directions, buy side draws and sell side draws and liquidity before we continue making our move to the upside. So you could obviously see just by pattern recognition that these days are a lot more probable because the market is actually running to draws and liquidity. We're actually moving with volume. We actually have the banks and institutions pumping orders to give us volume to go take out liquidity. And inevitably, these will be the better sessions to trade. And then the second thing I said was inverse for value gaps if you want a good one or a bad one. And so a lot of the times you want to execute on the most V-shaped recovery IAVGs. A lot of the times what you'll see is if market runs down, leaves a fair value gap right there, and then we slowly go and inverse it within 5 to 10, 15 candles on the 1 minute or 2 minute time frame. A lot of the times the speed is not as good. You want to see volatility, so you want to see perfect V shape. A V shape like this is literally an A+ setup right here, because this means that there's a very strong shift in order flow to now switch to bearish order flow. And so now a good example of an IFVG that we want to utilize is after we take out a premium sell side liquidity target and then we see a nice V-shaped recovery. Typically the best IVGs that I've seen in my years of trading or whatever are within about 2 to 3 candles of an inversion close. So you can see we make the fair value gap right here. We have 1 candle to the downside, and then this candle doesn't inverse it, but the second candle inverses it. So that shows us that we have good volume and a good change of direction into where price is going for our inversions. This video is not specifically over inversion, so I won't go too in depth into it. But you can see just from pattern recognition that this is a lot better of an inversion to enter off of for longs. And then you can see that it actually plays out. If I go and click the playthrough mode, you can see how good the trade ends up playing out to the upside when we enter off of good inversion closes. So now we can apply the same thing in this essence right here, where we have this 1 minute inverse fair value gap. In hindsight, this isn't a bad inverse, but the thing is you want to pay attention to the close. Look at how low we close this inverse right here and how far away our stop loss would have to be above this swing high. So a lot of the times, in my opinion, if the close right here isn't close to where the inversion is at, like within this range right here, and we close way below here, about a what is this, like 25 point close below the inversion, a lot of the times I would just fade it because it's too high of a close for me to feel comfortable entering the trade. You never want to enter inverses when even though the volume is good, a lot of the times you don't want to enter inverses like this because your RR will be fucked in a trade like this. So I completely just fade these setups. Even though this setup does end up playing out, a lot of the times it won't. The point of this example right here isn't for the setup to play out. It's for you to see where the inversion closed and how to know when to avoid bad inverse or value gaps. Mondays and Fridays are typically less probable conditions. They're typically less probable days. And by less probable, I mean there still are going to be setups on these days. There's still going to be setups every day in the market, but they're going to be less probable for them to play out. They're going to be a little bit more choppier. They might wick you out and then run a TP. That's what I mean by less probable. So there will be setups on these days, but the win rate of you hitting a trade on Mondays and Fridays will typically be lower than the days of Tuesday, Wednesday, and Thursday, which from my discretion and from my data collection, I've understood that these are the more probable days. And these are typically the days that you see me being more risk on in the market. For example, if you guys are in my Discord, I have yet to have traded a Monday this entire month of May. If you guys are in my Discord, you've literally seen me hop on the live calls and not take a single execution every single Monday this month. It's because I understand that Mondays are less probable. A lot of these Mondays aren't delivering in the way that I want to. So a lot of the times I just fade the day. And so I've actually refined my system to taking a Sunday open trade to where I'm already up on the day and I don't even have to touch Mondays in that essence. So that is the reason I fade those days. From my system and from my discretion, I've understood that to be correct. Now, I will get to one more point about this in a little bit. Number 3 is what news events and or times are days that we should be avoiding. Number 1 will be the days before FOMC and CPI. Any major economic news event that is happening, typically you will see the market either start to price in what's going to happen, or you're going to see the market slow down in order for the event to take us to where we want to go within the liquidity, within the draws, wherever we are within the specific market. So typically the days of or before these major economic days, especially FOMC and CPI, are going to be a lot slower, and you want to be a lot more risk off on these specific days. Number two, which is very, very obvious, and if you don't know this already, you might be cooked as a trader, but bank holidays. So bank holidays, if you guys are watching this recently, or as in the time of this recording, we have Memorial Day coming up this Monday. What a bank holiday does is that typically the banks and the institutions aren't trading, and since they have the most liquidity, they have the most capital within the market isn't moving as volatile as it is on a Tuesday, Wednesday, or Thursday. So a lot of the days when these banks aren't even trading, the volatility will be bad at market open, and a lot of the times we won't even move. We'll just stick in a range. We'll be choppier, and there's not going to be as high probability conditions trading those days as opposed to waiting for a higher probability day. Number three will be the 10 a.m. candle. This is honestly a very slept on one. A lot of people really sleep on this one, but the reason the 10 a.m. candle is a very, very dangerous time to trade, and by 10 a.m. candle, I mean like literally when the clock hits 10 a.m. Eastern time. The reason why this candle is a little bit more scarier to trade is because it's the open of a new higher time frame candle. So it's the open of a 4-hour candle, it's the open of a 1-hour candle, it's the open of the obviously everything else, all those increments in between that as well. So a lot of the times you'll see 10 a.m. be very volatile. Just that candle alone, you'll see a very volatile 10 a.m. candle. And if you're in a position or if you're looking to get into a trade, you could get stopped out or cooked out of the trade very, very quickly. The last thing will be the 9:30 a.m. candle. I feel like this one's kind of obvious, but not some traders may not know this. But you should very rarely be taking a trade at 9:30 on the dot, unless the drawn liquidity is so obvious and you are 100% convicted into the trade that we're going to go run that. It is a very, very dangerous time to trade because, as you guys have seen, if you guys have been trading for some time, 9:30 a.m. will open. We will wick in crazy direction. Sometimes we're volatile. Sometimes we'll have a 50-point 9:30 a.m. candle. Sometimes we'll have a 10-point 9:30 a.m. candle. So it's a very dangerous time to trade. A lot of the times with my system, I actually just wait for the 9:30 a.m. candle to close, and then I get an idea as to what the market will do. The first 5 minutes of market open sometimes are very, very volatile, very, very scary times to trade. So a lot of the times you just want to react off of what the market shows you and be very patient and risk off until you see a setup develop throughout the course of market open. That, from my understanding, from my discretion, is the solution as to avoiding bad setups, avoiding bad times to trade, and inevitably increasing your win rate. Because at the end of the day, if you can avoid bad setups, avoid bad trades, avoid bad days, avoid bad sessions, then inevitably you will be able to increase your win rate. And so the last thing that I didn't write here, as far as what news and events or times or days to avoid or whatever, is Asia session. Holy fuck, I cannot speak enough about Asia session, because Asia session will fry you, especially if you're a newer trader. If Asia is a part of your strategy, then you can completely disregard this. But if you are a New York trader and you know that you have a statistically worse win rate in Asia session, you should not be trading Asia session. Even for me, I still struggle with this sometimes, but I've got better at this by utilizing the lockout feature. But Asia session should be something you should be completely avoiding. Why? Because Asia session is a lot of the times is very slow, very choppy, very rangy. You're gonna have to size very high in order to catch a good amount of points, and it's just not probable, especially if you're a New York trader, because if you go from New York to Asia, you will see a very, very vast difference in the two sessions, rather than just trying to take a trade during New York. So the only time that I allow myself to trade Asia now at this point is when we get that Sunday open, because we typically have good volatility for the first like 30 minutes of open, and then we'll slow down. So besides that, I'm typically not in Asia anymore. If anything, pre-market is the only time that I'll take a trade outside of that. So really, what will help you the most in this criteria at the end of this will be your own data collection and self-reflection. No matter what I say in this video, everything that I will say you should just take it with a grain of salt, because when you go and you back test your system and you journal your system and you live test and forward test your system, you will have a good understanding to know what times are the best to trade, what times are the ones to avoid, what days and sessions are the ones to avoid and the ones to trade. So even though I gave you guys my blueprint as far as to what works, and you guys can feel free to screenshot this as well, it may be different for you. And so that is why the most important thing out of this entire video that I cannot reiterate enough is that don't just copy this and blindly follow it. You want to copy it, see how the results work in your system, and refine it over time, because then you will be able to have your own system that works catered and specifically towards you as a day trader. And so that will be the most important thing for you going forward as a trader. And so the goal of this whole video is that you will learn to take advantage of expansion days and volatile days, and also learn how to fade bad setups and choppy conditions. Because at the end of the day, if we can take advantage of the days that we have good PA, good volatility, and we can just completely fade the days where we don't have those conditions, then our win rate will go up, our success will go up, our payouts will go up, everything will go up as a trader, because we're only executing when the model presents itself the best. So I hope this video helps you guys. If you guys have any questions, make sure you guys comment them below or DM me on Instagram. I answer all of my DMs. And if you guys are looking to join a free community, a free Discord where I trade live every single day, you guys can click the link in the bio. I have it linked there. If you guys are looking for coaching or as far as helping within your one-on-one experience within trading, I have an offer below as well. You guys can apply to join as well. However, do not apply if you're not serious about trading. So without further ado, you guys enjoy the rest of your day, and may God bless you guys along your journey.